tough call for the Bank of England. Cut or stay put? The Bank of England looks set to hold fire on interest rates, potentially breaking the once-a-quarter rhythm of cuts it's kept for more than a year. Still, some analysts say markets may be underestimating the odds of another cut. And with Chancellor Rachel Reeves just weeks away from unveiling a new budget, will policymakers play it safe or take the plunge and cut anyway? Jeremy Stretch is Chief International Strategist at CIBC Capital Markets. So Jeremy, Governor Bailey said in September they would be watching very closely how the economy evolves. As we head into this decision, what's the economic picture looking like for the UK?
Well, you're absolutely right. That was the narrative that Governor Bailey outlined. And I think what we have seen subsequent to that policy comment is we've seen inflation for September coming in below that expected by both the market and the Bank of England. So that's the good news. So that suggests that we may have seen a peak of inflation sub 4% in terms of headline. That's good news. We've also seen average hourly earnings starting to soften. So that's good news for those that are looking for rate cuts. But we have seen a resilience in terms of the Q2 data. And of course, if it weren't for the budget, I think the probability and the expectation for a policy adjustment at this meeting would be substantially higher. But because of that budgetary uncertainty, I think the bank will probably decide that it's prudent at this stage to leave policy on hold, but leave the door very much ajar for a December cut. So still meeting the once a quarter profile, even if it's not quite the same as previously in terms of in line with monetary policy reports. But I think it may well be the case that not only cutting in December, but perhaps a sequential cut in February as well, as we do see inflation coming down and or the prospect of fiscal tightening. So a close vote this week, yes, probably 6-3 for no change, but potentially policy easing coming at sequential meetings in December and February.
Well, the consensus is shifting and some major banks are seeing a cut for tomorrow. If that comes, does that rule out another move in December? Could we see a tweak to their guidance, dropping its gradual and careful approach?
Well, I think it would be something of a surprise were the bank to act tomorrow. I think we can safely say that the hawks and the Monetary Policy Committee are going to be very reluctant to embrace easing at this particular juncture. So I think that puts the onus very much on three bank insiders, including Governor Bailey, but Sarah Breeden, I think, is probably going to be the other influential one. Both Breeden and Bailey have voted in tandem ever since Breeden joined the committee in late 2023. And I think it will be very much a surprise if they were to adjust their policy stance now. But if they did so, then I think the market would amplify rate cut expectations. And accordingly, that's been one of the reasons why sterling has been a net underperformer over the course of the last couple of weeks or so, since we saw that benign CPI print, as markets have amplified rate cut pricing. But I think there's probably still not enough priced in for the February meeting. So we're only pricing in just a little over 30 basis points. So I think there is still scope for a more aggressive stance, even if the bank don't necessarily change their guidance alongside any vote tomorrow.
This meeting as well marks the debut of the bank's new communication style. They'll be publishing forecasts on the majority view. Will we see less divide in the MPC?
I'm not sure we will. I think actually the opportunity for each individual member to outline their individual stance, I think, underlines the opportunity for significant communication enhancement for the individual members. So I think it gives more leeway for some degree of a sort of a personal perspective. And so I think that probably is going to be increasingly underlining the differential positions and standpoints of the various MPC members. So I'm not sure necessarily it's going to provide a more convergent view. I think it will just underline the differential intellectual biases of the individual members, and I think that will be certainly healthy from a market perspective.
Well, the pound just hit a 7-month low yesterday as Rachel Reeves outlined the scale of the UK's fiscal challenges. Is that a preview of the reaction on budget day itself?
Well, I think the reaction in terms of fixed income space was quite interesting to Rachel Reeves' speech. We did see gilts rallying in the early phases of the speech when she was talking about ironclad fiscal discipline. I think the markets were slightly disappointed there wasn't any meat on the bones in terms of detail, although actually in reality, just over 3 weeks away from the budget, there was never going to be detail overall. But sterling has proved to be a net underperformer. And I think that's partly a function of rate cut expectations. And so we have and did see briefly expectations for a December policy cut almost reached 20 basis points yesterday. That was a catalyst for that sterling underperformance. And so I think if we are going to see a more aggressive policy stance through the first quarter, then that potentially is going to keep sterling somewhat on the defensive. But I think the converse or the alternative argument will be that if we do see monetary easing coming through slightly faster than expected, that will have some degree of influence on the consumer side and or on the growth narrative. So I think it may be an opportunity to look to pick up sterling at cheaper levels into early part of next year, if we assume that the Bank of England hold rates at what we would consider to be 3.5, which is neutral from the middle of Q1 onwards.
That was Jeremy Stretch from CIBC Capital Markets. Don't forget, you can watch more videos on Reuters.com.